Okay, now here's the problem with the IUL policies and universal life policies in general that we're seeing today. And again, I want to emphasize this. National Life Group is not a bad company. It's a good company, and this product is a good product, but there are better products out there. And like my mentor always says, don't let good be the enemy of best. If you have an option between sticking with something that's good or moving to something that's better, pick the better option. Do something better, do something different, make a change. So this letter is actually to a client, and this is the problem that we see moving forward with the volatility of the market. These IUL policies are credited. The interest is actually credited to your account based on the performance of the S&P 500. Well, over the last 5 years, the S&P has been up over 150%. And so they've had to credit these accounts to the tune of 10.5%. Well, all insurance companies make money the same way. What they do is they take your premium dollars, the money you give to them, and they invest it in the form of bonds or loans. A bond is just a loan. And so they loan that money out, and loan rates right now are really low. And they keep them short-term loans. They don't buy U.S. Treasuries or something that, the 10-year Treasury, I think, is at 2.6%. So if they were buying those bonds, they would only be earning 2.6% and paying you 10.5%, which is the cap rate. And so that just wouldn't make sense. But what they do is they'll do short-term loans, 1 year, 3 year, 5 year, sometimes 7 years, but never longer than that. And they charge on those loans, on the loan interest, they charge anywhere from 6 to 8% generally. But even if they're earning 6 to 8% on your money, if they're having to pay you 10.5%, that's not profitable for them. And so the challenge becomes, where do they go? Where can these life insurance companies go when they're having to credit you 10.5% on your account? Where do they go to make up the difference? How do they become profitable again? And here's the answer. It's actually in the contract itself of the Universal Life Policy, or the IUL policy. So let's read it. It says, this policy is a flexible premium product, just like yours. The monthly cost of insurance may vary during the year and typically increases on policy anniversary date. The current modal or billable premium, that's your annual amount that you're putting into the contract, is no longer sufficient to cover the monthly cost of insurance. The charge for the cost of insurance has increased to approximately, and in this client's scenario, $18.51 a month. And your premium, your modal premium, which is monthly premium amount of $988.50 a month, is not sufficient to pay the monthly insurance charge. Here's the key. This is where it gets kind of scary for us. Should your policy have sufficient cash value to cover the cost above what you're paying, the difference will be deducted from your policy value. If there is not sufficient cash value to cover the difference, the policy will lapse according to the provisions contained in your policy contract. And so that's the gotcha in these IULs. And that's something that we didn't design these for. What we did was we designed these policies to have a decreasing death benefit over time, or a death benefit that would eventually drop off over time, so that if there were increased charges and expenses and fees, it would kind of balance it out. But the challenge we're having right now, Justin, is that the market is so volatile that these companies are having to buy options just to cover their butts. And that optionality is getting very expensive because of the volatility of the market. And so they're not profitable, and there's only one place they can go to recapture their profit. Guess where that is? It's the policyholders. These universal life contracts are just like a renewable term contract. So every year, the policy costs and charges can change. And so what we're doing now is we're getting everybody that we can out of these policies. And so far, every single person that I've contacted and done this with, 100% of them have transferred their policies over into the new contracts that we have available where the costs are guaranteed never to go up. And with the new contracts, with the cost guarantee structure and the cost never ever going up, you actually get better internal rates of return. The more times you borrow the money out and repay those loans, the more efficient that policy becomes and the greater the compounding effect. And so that's the goal. My goal is to get you to move this contract with LSW into a new properly structured product that we have available today where the costs are guaranteed never to go up. The new guaranteed cost structure is actually written into the contract itself. So the difference between this account and the new account, the chassis is the same. We design it the same way for maximum cash value, minimum cost, minimum death benefit. They're both identical that way. The difference is in the contract language itself. On the UL or IUL products, the contract language states that they can change the cost every single year to recoup their profitability. On the new contracts, the contract language itself says that they cannot do that. All right. I'm going to I'm going to create another video to actually show you some other stuff that's important to you. All right. So call me when you can.